Good afternoon, everyone. Welcome to a TradeStation webinar. My name is Jesus Nava. I'm the Director of Client Training and Education for TradeStation Securities, and it's a pleasure for me to be hosting this event. Our guest speaker today is Ed Tom. He is a Senior Director at CBOE in the Derivatives and Market Intelligence area, and we'll get to him in just a moment. But today's presentation is all about index options. The title is Navigating Markets and Mitigating Risk with Index Options. So it's a great opportunity for us to learn a little bit about index options if this is a product you haven't traded before, and how you can use it not only to trade the markets, but also to mitigate risk. But before we start on this topic, let's go through some of the disclosures. Keep in mind that every symbol and idea that we talk about is for educational purposes only. These are not recommendations of TradeStation, of course. Online trading is risky, and it should only be done with risk capital, especially when it comes to trading options, which carry a high degree of risk. And past historical performance is no guarantee of future results. We have all the links here for the options disclosure. So make sure that if you need a little bit more information on this, go to www.tradestation.com/important-information. This webinar is part of our series of options education pieces that we're doing to teach our clients on advanced and complex option strategies. I want to take an opportunity to make sure that you are aware of the Options Education Center. All you need to do is go to tradestation.com, hover over Learn, and go to Options Education. We have a dozen of unique articles and webinars that you can watch on advanced option strategies. This particular webinar that we're having with Ed Tom is also going to be recorded and is going to be available in the Options Education Center. So if you want to replay the webinar, just make sure that you bookmark this page for additional education. All right. Ed Tom, as I said before, comes from the CBOE. He's an expert on options and derivatives. So let's go ahead and give him a warm welcome. And Ed, I'm just going to pass the microphone over to you, okay? The floor is all yours.
Okay, thanks, Jesus. So ultimately, the equity volatility and options markets are in the business of pricing risk. So over the next 40 minutes or so, I'm going to quickly go over the risks that the option markets are pricing in, how we discern that, and then discuss how traders are currently using tools within the equity index options world to kind of like mitigate some of that risk. Okay.
You can start the presentation, and I'm sorry to interrupt you. The slideshow, just from the beginning, the far left.
Okay. Right. Okay.
There
Thanks.
we go.
Gotcha. Okay.
Okay.
Thank you. All right. All right. All right. So to start off with, I'm just going to give a quick overview of the state of the markets. So since COVID, we've had a historical run for S&P. So S&P has rallied about 22% per annum since COVID, amidst an increasingly stable market environment. And when I say a stable market environment, I'm using the VIX to measure that. And as you can see up the graph in the upper right, there's an inverse relationship for the most part between S&P and VIX. So basically, like as the S&P rises, VIX tends to fall, and as S&P falls, it tends to rise, right? So you can see in the big graph in the middle, since 2022, we've had decline levels of VIX. So VIX has declined from 26 in 2022 to 17 last year. And this year it's been trading around 14. Now, to kind of put that into perspective, the historical average levels of VIX is around 18 to 20. And the absolute low levels of sustainable VIX is around 10. So basically like 10 and 12. So 14 is actually pretty low, okay? All right. So a question that we've been dealing with for the last few months is that, okay, well, with the S&P at all-time highs, why was the VIX still relatively elevated? So up until yesterday, or actually up until today, VIX was consistently around 20 for the last 2 months or so. Okay. And to quickly kind of like give an explanation as to why that is, I'm going to refer to this diagram, which kind of explains the composition of the VIX. So the VIX is comprised of three parts. The first part is the volatility due to economic fundamentals, which we kind of proxy using realized volatility. And then we layer upon that the demand for puts versus calls on behalf of portfolio managers as they hedge risk in their portfolios, call that skew. And finally, the third component is the premium that traders charge in anticipation of tail risks, which we call either kurtosis or convexity. What this graph kind of illustrates is that, like, if you look on the graph on the left-hand side, what skew is basically is uh, additional premiums that traders price in anticipation of potential risks to the downside that is more than expected by the bell shape or normal distribution. Okay. All right. As we enter into year end, we've had a number of risks that index option traders were grappling with, including lessons from the yen carry unwind, geopolitical risk, Q3 earnings, the U.S. presidential elections, the macro interest rate environment, and year-end positioning. And to kind of like analyze those particular risk catalysts, what we're going to do is we're going to refer to different aspects of the volatility surface. So to explain the yen carry unwind and its effects, we're going to reference index skew. To discuss geopolitical risk, we're going to examine vol. For Q3 earnings, we look at stock correlations. For the U.S. presidential elections, we look at the term structure. Um, the interest rate environment has been a major theme. So we're going to examine something called volatility contagion effects. And for that, we're going to look at the market correlation structure. And finally, for year positioning, we're going to examine put call supply demand dynamics. Okay. So as I mentioned before, the largest component of the VIX is due to the volatility stemming from economic fundamentals, and a really good proxy for that is realized volatility, right? So at this moment, realized volatility is 10. So what that means is that, like, if you were just to base volatility purely on economic factors, then the level of VIX would be moving much lower than it is today. Okay. All right. So there's a certain amount of seasonality to how traders kind of price their premium in excess of economic fundamentals. And in part, that's due to expectations for how volatility kind of trades throughout the year. And as you can see over here, what we're showing is that that in general, traders expect volatility to be relatively high after in September, October, November, but relatively low in summer months. So what they do is they price the VIX accordingly. So they tend to like lower the volatility surface and lower the price of optionality in the summer months, and then raise them up generally about 3 weeks after we get back from Labor Day in anticipation of Q3 earnings. Okay. So, so what happened this year was that, for the first few months of the summer, we had extremely low levels of volatility. And on August 5th, that all changed, right? So on August 5th, that was the date of the yen carry unwind. So as you recall, the yen carry unwind started in Japan, where we had a 12.5% drawdown in the Nikkei. And what that led to was pre-open for the U.S. The S&P traded around down 5% pre-open, and if you kind of like look at what the VIX was implying for a daily move, the VIX at that point was 23. Before the date of the yen carry unwind, which said that like traders would expect a daily move about 1.5%. So a 5% drawdown in S&P equates basically to like a 3 standard deviation move. So what happened was, as the S&P plummeted pre-open, the VIX surged. So the VIX surged to 65, 72 pre-open. As the traders basically raise the volatility surface and therefore raise the price protection as PMs try to jump in to hedge their bucks. Okay. Um, so the yen carry unwind basically resolved itself in one day. So by the next day, everything kind of normalized, but not in the volatility space. So over here, what we're doing is we're showing a graph of the skew. So both cross-sectionally, which is the graph on the left, and as a time series, which is the graph on the right. Now, as a reminder, what skew is it's the relative demand for puts versus calls on behalf of portfolio managers. So basically, as the demand for puts increase, skew tends to rise, and as the demand for puts decline, skew tends to fall. So what you're seeing on the graph on the left-hand side is basically like a snapshot of what happened in reaction to the skew in reaction to August 5th. So traders um, lifted the price of risk and lifted the price of optionality, and they also steepen skew, meaning that like they charge significantly more for puts after the event than before the event. And you can kind of see that as a time series on the far right. So the time series kind of maps out the differences between a 9110 skew, and you can see that as we get toward September, skew was relatively elevated compared to the prior months. So all that means is that for every percent move in the S&P, traders are now pricing in a significantly higher level of volatility. Okay. And another thing that's been occurring in October was obviously like Middle East tensions. What we have over here is basically like a graph of the evolution of excess risk premium due to the first week of October, when basically like Iran launched a series of missiles against Israel, and then Israel in return uh, basically threatened retaliation against Iran's oil and nuclear facilities. So basically, what this is showing is that that the VIX started to accrue at about 3.5 vol points of additional geopolitical risk premium on top of the baseline economic fundamental risk. So in essence, this is partly why like the VIX was so elevated during the month of October. So it should have been around 15 and a half. But because of this extra geopolitical risk, VIX was trading around 20. And this is just like a view of how the skew dynamics look heading into November. So we have two graphs over here. On the left is skew for S&P options, and on the right we have the skew for VIX options. Now, think of the skew for S&P options as the risk premium for traders hedging moderate declines of the S&P. So when I say moderate declines in S&P, I generally mean 1 to 1.5 standard deviations down. And on the right-hand side, we show how traders are pricing in um, uh, risk premium for extremely large declines in S&P. So basically, like in that case, I'm referring to any type of drawdown in excess of 2 standard deviations. And the general takeaway from both of these graphs is that heading into October, not only have traders steepened and increased the price of put protection for moderate downside moves in S&P, but also they significantly raised the price of risk for large downside moves in S&P. Um, so aside from some macro fundamentals, traders have also been concerned about Q3 earnings. And in one sense, Q3 earnings is part of the reason why oftentimes you do see a increase in volatility coming into October, November of every year. And what these graphs show on the right-hand side is basically like the level of dispersion amongst the S&P stocks. So basically, the general takeaway is that as stocks become more correlated, it becomes much more difficult for stock pickers to generate alpha. And the reason why is because even though you might be picking, let's say, the correct long short pairs, you're not really getting rewarded for it because stocks are fairly moving in unison. And by contrast, if stock correlations were low, then you would basically be able to monetize your correct stock picking abilities much more effectively. So what we're seeing is that, like, as we're moving into November of this year, stock correlations have increased and stock dispersion, sorry, stock correlations have increased, stock dispersion has declined, making it much more difficult to generate alpha. Now, as we enter, as we work through earnings, oftentimes we refer to a number of analytics from the option markets to kind of help us inform what option traders are expecting for every optional company going to earnings. So the two characteristics that we focus on is the option implied earnings move, which we glean from the implied volatility of a particular option. And the second thing is that we examine the skew, which helps us determine the directionality of the move on earnings. So what we have in the table over here is the Mag 7 stocks and the respective report dates. And all the way to the right, we basically impart we show the skew bias, basically the relative demand for puts versus calls ahead of earnings. And um, if you were to kind of like so basically we snapped this data at about 2 weeks prior to earnings, and basically a quick look back at how this analysis performed relative to actual earnings is it actually did pretty well. It the interesting thing is that, like, for a lot of these Mag 7 companies, even though they reported positive earnings, the guidance was actually lower than expected. So the option market basically had a pretty good view on how the stock was going to trade based off of guidance, not so much based off of the earnings. So on the graph on the right-hand side, what we have is basically like a implied probability distribution for NVIDIA, which basically shows for any given target stock price, what the expectation the option market has of hitting that particular stock price. And the main takeaway is that, like, at this point, well, actually 2 weeks going into NVIDIA's earnings, we saw that there was actually, like, option traders were pricing in a much lower probability of NVIDIA hitting any particular stock price than they did a month and a half ago. For events, oftentimes we refer to the S&P implied volatility term structure, and I think the more interesting event, for this month, obviously, is the U.S. presidential elections. Now, normally, the implied volatility term structure is upward sloping. So what the implied volatility term structure is basically like it describes the evolution expectation of volatility on behalf of volatility traders for different points in time in the future. So on the x-axis, you can see that we have different dates going out into mid-November, and normally the volatilities rise as we move forward in time in a pretty smooth fashion. And the one uh, point that I wanted to kind of highlight in this particular graph is if you look at November 5th, 6th, you see that there's a very large upward sloped move in the implied volatilities. This is known as a kink. And what this kink represents is additional risk premium that traders are pricing in for an event. And in this case, the U.S. presidential elections. So um, on the date that this was measured, the kink was about 3.5 vol points. Normally going to presidential elections, we see like a kink of like 1.5 vol points. So when we measured the same kink on November 5th, the day before the presidential elections, the size of this risk premium actually increased to 10 vol points, which basically means that the markets expected the S&P, underlying S&P, to move a lot more than expected. So, and it played out pretty much as volatility traders had expected. So today, the S&P rose about 2.5%, and the premiums that the expected move on behalf of volatility traders was that they were pricing in a move of 2.25%, which is pretty close to the actual move. Okay. Um, so in addition to like a macro view of events, oftentimes traders also drill down to the sector level because a lot of times what causes that volatility kink is the effects of different sector rotations due to uh, different policies on behalf of the presidential candidates. And basically what this is showing is that for the most part, there are three sectors that are very impactful um, for the markets that are really major differences between the two candidates, and those sectors are financials, energy, and technology. Um, and basically, what this chart shows is that the markets were expecting fairly large moves in all three sectors, um, given a Trump win. And that's pretty much kind of what played out. So today we had about a 4% increase in technology and about 3% increase in both financials and energy. Okay. Um, Over here, what we're doing is we're kind of comparing side by side the S&P volatility term structure with the VIX implied volatility term structure. And just a reminder, the S&P kind of reflects moderate moves, and then the VIX term structure reflects very large shocks, basically. And you can see that the graph on the far right shows that volatility traders were expecting a very large move going into the U.S. presidential elections. So you see that the risk premium for VIX options basically double from one day to the next. And oftentimes you do not see this, right? So oftentimes the curve is relatively steep. And yeah, again, this goes to explain the reason why we've had the extra risk premium for the VIX. It's because of basically two factors: the U.S. elections and also the geopolitical risk premiums. Okay. So one thing that oftentimes we track is the contagion effects from other asset classes onto equities. And the reason why we do that, because if you consider over the last 25 years, the times in which the equity markets had the largest drawdowns, um, it was basically in response to risks from other asset classes. So whether it be the global financial crisis, the sovereign debt crisis, different oil shocks, So oftentimes you, you see that it's because of risks that are external to the equity markets that cause the largest increases in equity volatility. The graphs on the right hand side kind of demonstrate why that is. The bubbles on the far right, upper right, show basically like the size of the volatility from equities and some other asset class. We call it X asset volatility. Um, and when they're trading fairly independently of one another, it has virtually like no effect upon equity volatility. But you can see on the graph on the bottom right, when there's an overlap of the two markets, when basically there's a transference of volatility from another asset class onto equities, what that tends to do is it inflates equity volatility, oftentimes very significantly. So we're showing in this correlation matrix over here are assets that at this point are highly correlated, sorry, have a high degree of contagion effects upon equities. And the main takeaway is that, like, for the most part, the assets that are highlighted are all related to interest rates at some point, at some level. What's fairly interesting, though, is that if you look at not just the nominal level of volatility contagion, but at the trends, what you see over here is that that there's been higher trends toward equity volatility stemming from volatility contagion from oil, as well as from FX and copper. Now, what kind of links all these assets together is that they're all related to economic growth. So basically what the correlation markets are saying is that, like, the equity markets right now are particularly vulnerable to any type of data or information that basically convey news, whether it be positive or negative news, are relative to economic growth. So meaning that the equity markets right now are highly sensitive to economic growth information. Okay. So and finally, I think the one last risk that I kind of want to cover was year-end positioning to kind of convey like how volatility traders are positioning for year end. And what I'm showing the graph on the right-hand side is basically the skew uh, from 4 weeks ago, which is the light blue, versus the skew currently, which is the dark blue. And what you're seeing is that, like, there's basically like a lift in the skew surface for both deep out of the money puts as well as deep out of the money calls. So the term we use for that is convexity. So basically what this means is that, like, volatility traders are positioning for either a very large move on the upside or a very large move on the downside. And what they're doing is that to fund the purchase of these out of the money puts and calls, the selling the at the money options. So overall, what that means is that traders do not believe that the S&P will stabilize at the current level. They believe that by year end, the market will either move up significantly higher or significantly lower. So it's kind of like, summarize like the outlook going into next year. S&P is at record highs. S&P valuations are currently high. They're at a 92nd percentile, and Fed fund futures are pricing in about 6 to 7 cuts over the next year. So meaning that that we're going to see decreased yields for many instruments going into next year. So obviously, like, um, two of the three top concerns of clients that we've talked to, and the clients that we talked to, for the most part, are about 60% institutional, and then 40% high net worth. And I would say the two top themes are risk management, meaning that they want to be able to capture upside performance while mitigating the left downside tail risk, and for the next year as yields decline. They're concerned about figuring out ways to enhance yield and provide consistent income without taking on duration or credit risk. Okay. So, so the 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 products that are often used to kind of like answer those, provide solutions to those conundrums, um, are highlighted below. So basically, like starting from the left-hand side, to risk to basically to hedge against tail risk, which means basically hedging against extreme sell-off. Um, Volatility traders are basically buying out of the money protective puts on an equity index. So basically, like the example I showed here is that they're looking to hedge about 2 to 3 standard deviation move to the downside in S&P by buying deep out of the money about 10 delta puts, right? Um, on the flip side, to provide yield enhancement, they basically generate income by selling calls. So basically, the technique they use is basically they're selling calls in excess of about 1.5 standard deviations to the upside. All right, um, and basically a combination of these two techniques is called a buffer downside protection trade, where basically like they allow for a moderate degree of upside appreciation while mitigating downside risk by funding an out of the money put spread with proceeds from the sale out of money call. So in this case, what you're doing is you're giving up upside in excess of 1.5 standard deviations um, to to basically fund protection for any moves, downside moves in excess of 2 standard deviations. So basically, what you're doing is you're giving up extremely unlikely scenarios to the upside to be able to protect yourself from bizarre downside moves in the S&P. And what you're hoping for is that the S&P basically trades between between current levels and 2 standard deviations to the either upside or downside. Now, so it is possible to create the positions that I mentioned by basically buying um, puts and calls and what have you. Another alternative is to buy a package. So basically, like what we've seen is that over the last few years, uh, there've been there's been a rise in the demand for options embedded ETFs. So you can see from the headlines over here is that like there's just been a lot of chatter in the media and the financial press about different types of options embedded tools to basically both hedge downside risks as well as to generate yield. Okay. And you can see over here, basically like that's basically led to like a huge explosion in option-based ETF AUM. So over the last 5 years, option-based ETF AUM has grown seven times from 200 billion. Sorry, from about a little bit less than 50 billion to 200 billion today across 300 different funds. Um, there are different ways to kind of like you know, determine whether or not any type of strategy suits well with your portfolio. And the way to go about doing that is basically to back test the particular option embedded ETF with your portfolio. So what I'm showing over here is the efficient frontier of a equity portfolio using various amounts of options embedded ETF. And the main takeaway, which is shown on the table on the right-hand side, is that in general, what you see is that for fairly normal markets where the S&P is trading within 1 to 1.5 standard deviations, oftentimes you see higher returns with lower volatility. So meaning that you see a sharper ratio when you include options-based ETF into your equity portfolio. Okay. So for the next few, for the appendix, what I'm just showing is the different types um, of options-based trades that we SIBO has created ETF index products with. So basically, to quickly backtest whether or not, let's say, a buy right or a put right or a collar strategy is suitable for your portfolio, you basically use these tickers to kind of proxy what the strategy will be in the context of your portfolio. Okay. And finally, one thing that we do offer is we send out a weekly commentary. It's called the Macro Volatility Digest, which basically summarizes uh, how option traders are positioning for the past week and how how basically they've assessed risk and how they've priced risk across different macro and micro single stock catalysts. All right, so Jesus, I think at this point, if the audience has any questions, I'd be happy to field them.
Thank you, Tom. That was some interesting information. I haven't seen any questions come in the chat, so I think either the information was clear or I don't see any activity here. Where can where can the audience find additional information on this, Ed?
If they subscribe to the macro volatility digest, so we'll send them the report basically every Monday.
Okay. Would it be okay if I share your PowerPoint slides with the audience?
Of course, yeah.
Okay, so if anybody here would like access to Ed's presentation, please send us an email. Let me share our team's email address here in the chat so that you can request those. It's education@tradestation.com. Okay. Yes, it was a lot to digest, as Frank. Definitely was. Yes. Thank you. Thank you
Yeah.
for.
Yeah, I mean the point of the presentation really is not to like absorb everything that I've said, but really it's so the audience can get a sense for like what type of techniques and analytics that option traders use uh,
Mhm.
to kind of like analyze risks. I mean like to be able to like to basically to undertake any type of the analytics that I showed, that they basically takes like another session of class, right?
Yeah.
But I just want the audience to be aware of the tools that are currently used and the extent to which the volatility service can be used to kind of like assess risk.
Yeah, being able to see, how different events and different situations can affect the volatility gives you a different perspective and a different way of applying. It's good to know, which strategies to apply under which scenario. So thank you for that, Ed.
Yeah, I mean,
Um,
I'll leave with one last thought. I mean, like
yeah.
one of the slides that I do show is
Mhm.
I'm going to go to it. So so basically is this one. Often basically this is basically the option markets basically forecast of what to expect for any given stock going into earnings. And oftentimes I get the question, okay, well, how does this differ from you know the analyst expectations, right? Because Wall Street analysts also have views on how the stock is expected to move. Um,
Mhm.
and basically my answer is this. So oftentimes stock analysts have much longer horizons, right? So their forecasts are basically optimized to 1 year in duration. Um, whereas yeah, option traders are much more like short-term focused, right? As you know, we have options trading every day for indices, and at single stock level, we generally about once a week. All right. And the main difference between an option trader's view and a analyst view is that the an analyst has no skin in the game. So they can basically make a call on, let's say, Tesla, and they might say, okay, Tesla's going to be 2,000 a year, right? But if they're wrong, well, okay, well, there's no impact to them. But for an option trader, like they're basically buying these options, right? So like if they make the wrong call, they've lost money. Uh, so they are much more incentivized to get it right. So that's why like oftentimes like people prefer to look at how the option traders are interpreting expectations for a given move versus a Wall Street analyst.
Great. Good information. Awesome. Well, I don't see any more questions, so we're going to end it here. Ed, I want to appreciate, the time you spent with us. I mean, that was great, some great information. And I suppose everybody here can go to the CBOE website to learn about all the different products they offer, especially index options, as it was explained today. And Ed, thank you so much. Thank you, everyone that attended this webinar as well. Thank you for taking time to attend. And I hope to see you in a future class. Make sure that you look at the event schedule and see all the topics that are upcoming. So thank you so much for your time and have a wonderful afternoon. Ed, have a great day.
Thanks, Jesus.
Thank you.